In the last months of 2025, I bought five companies whose stock prices didn't perform as well as their fundamentals, and I strongly believe they will perform very well in 2026. Starting with Netflix, the stock price started the heavy decline when they missed earnings due to one-time tax in Brazil. Here. And the deal with Warner Bros. Discovery added to the negative bias. The stock is currently around 30% lower than its previous highs, and here is why I bought at $96 per share. Netflix is already in a very strong position. You can see how much they are growing. This is their net income, and they won the streaming wars, but they achieved it without owning exceptional intellectual property. With the acquisition of WBD, they will distribute Harry Potter, Batman, Superman, Game of Thrones, and many other blockbuster movies and shows to their over 300 million subscribers. But even if it doesn't go through, Netflix is doing very well and their fundamentals are growing heavily. Look at their net income. Their highest quarter ever is $3.13 billion. And the forecast is that 5 years, actually 4 years from now, in 2030, it will double. While revenue grew 14% year over year, their operating margin accelerated. And if we exclude the one time tax in Brazil, their net income would have grown 30% year over year, which is amazing. That means they have high operating leverage. If we look into their historical PE ratio, we can see that the median is at 51, while the current PE ratio, trailing 12 months, is 37. Now, if we look into the forward PE ratio, though, it's a different story. It's at 28x. Now, 28x means that it is much lower than the median, which I believe gives me margin of safety, especially compared to the 30+% growth. If the company stays at this level, I will probably buy more and accumulate bigger position. If you've watched until here, it means my content is valuable to you. That means a lot to me, and I would greatly appreciate it if you click at the like button and subscribe to my channel. Next is Amazon. I think this company is totally misunderstood by the market. They are in a spending cycle to meet the demand for AWS. That is the best spending a company can have. It's amazing. So while all their fundamentals are growing, free cash flow is dropping, and this is what scares investors. But look at the operating cash flow, which excludes the capex investments. It grew 36% year over year. Look into net and operating income. It went to the moon. Do you know why? Because of the exact same reason investors are avoiding the stock. AWS revenue grew 20% last quarter. Ad revenue grew 24%. These are the high margin businesses of Amazon, and they are growing much faster than the low margin retail business. The stock price moved up only 4% in 2025, while fundamentals went up. This is the disconnection I'm looking for, and I'm not considering the stories about robotics, space satellites, and autonomous driving. Moving on to Meta. Stock dropped in the second half of the year due to high capex and the narrative that there is no clear income from AI, which is the biggest BS you can see in the market. Look at their revenue growth. A company at that scale grew their Q3 revenue from $40 to $51 billion, and they don't see the AI impact? What kind of joke is that? How do they think the ads became more effective? Of course, it is AI. The algorithm became much more effective, retaining users more time on the platform and making ads more effective. We see the growth in the numbers. Net profit dropped so much because of change in tax laws, but it is a non-cash accounting tax. And their CFO mentioned that moving forward, the company will pay less taxes. So I bought at 650 and then I bought more at 613. Next one is MasterCard. The main issue with the company is that it is not AI, meaning fundamentals are growing quite fast, but the company didn't get the media attention and the stock price underperformed S&P 500 this year while growing net income 20%. They're operating in a duopoly with Visa and they are adapting very well to any threat coming in their way. Their network effects are quite strong and now their network effects are quite strong and now they're shifting towards SaaS business. They're selling payments data to banks, governments, and businesses. Their value added services revenue is roughly 40% of total revenues and it is growing faster than payments. The company is also backed by secular trends. Consumers are spending more money online every year and also they're using less cash. Having that said, if we look at their historical PE ratio, the median for the last 5 years is at 40x, and the trailing PE is at 34, which is much lower. But their forward PE is at 28x, which gave me margin of safety. I'm holding the company since 2023, but I bought more last month at $548 per share. The last one in the list is the most boring one, S&P Global. Unlike Netflix and Amazon, this company is rarely covered in mainstream media, so not many investors are aware that this is one of the most resilient businesses in the world with potentially widest moat. Similarly to Mastercard, but in a different way, S&P Global operates a toll booth to the economy. Whenever governments or companies want to issue debt, they need to be evaluated by rating agencies. The duopoly here is between S&P Global and Moody's, where those two companies hold around 80% of the credit rating business. That business benefits a lot from lower interest rates, and now we are in a cycle of cutting rates. But even when rates were higher, S&P Global was still growing in a very fast rate, mainly because of a major acquisition they did few years ago. In 2022, they acquired IHS Market for $44 billion dollars, and they paid only with their stock. You can see it on the shares outstanding chart. After that, they took debt and started buying back their shares aggressively, returning the money and the value to the shareholders. The merger was a masterclass where S&P Global significantly strengthened their offering and competitive advantage. The result is a very predictable business with 75% recurring revenue. However, this predictability comes at a cost for investors. The stock has been trading at high multiples with average PE ratio in the last 5 years at 38x. S&P Global is not an AI company and it didn't get any media attention last year, so the stock was up only 4.5% in 2025. As a result, their forward PE ratio is only 26x, which comes as a very big discount from the average of 38x. I own the stock since 2023, but I bought more in December at $524 per share. Let me know in the comments below what you think of this list of companies. Thank you for watching and good luck in 2026.